All right, so I begin with the official hello and cheers. I know it's not whiskey anymore. We're going to go with the coffee thing for a while, but welcome to another edition of Happy Hour with Doug. And you know what, guys? It's the first happy hour of 2021. So, on that note, I want to say first, Happy New Year to you guys. And I really hope that you had a great holiday. I know it's been a challenging year, 2020 was, and our holidays are much different this year than they have been in the past. But I hope, most of all, that you, your family, your loved ones are safe. And soon, very soon, I hope this whole new vaccine, this coronavirus disappears. I think we all kind of had the same resolution. I'm not a resolution guy, but I think all of us had the same resolution on 2021 is let's get rid of this coronavirus, right? So I hope you guys are safe. Now, I've been kind of taking a little bit of a hiatus here from YouTube. I've been bouncing around from city to city here, doing as much traveling as I can, but I finally decided with all the coronavirus and I'm just sick of living in the city. It was time for me to get back into nature. So I went ahead and got me this cabin in the woods. It's sweet. It's snowing like crazy. I haven't been in winter for like 23 years, but I'm having a blast. It's great. It's relaxing. It's refreshing. I'm reconnecting. So, on that note, one thing I wanted to say is I know you guys really love these happy hours, and I'm going to continue to do these. They're going to go back to every Friday now. So, I'm going to commit to them for the rest of the year. Every Friday, we're going to have a new topic. So, if you guys are coming by for the first time, you want to know what happy hour is, it's just really this time where, I share my experiences of 2 decades as a trader, the things that I've learned, the good, the bad. I answer your questions, and I just talk about the stock market. It's just sort of a sit down between you and I share the quality parts about what it takes to be a trader outside of things like technical analysis, scanning, and charts. So I'm looking forward to that this year. Again, hope you guys are doing well, and I really hope we this vaccine and everything works. So I wanted to go back to the mailbag on this one and talk about a theme topic I got over the last 2 months, something I've been meaning to talk about. And that is, I know there's a lot of new traders that are coming into the market, but a lot of people want to know, especially since the coronavirus correction and then the subsequent bounce, that how could all these economic numbers be bad and all this negativity and all of this unemployment, but yet the stock market still continue to make all-time highs? And I know that can be confusing at times. And the best way to answer that is if you first need to think this way, is that the economy is no longer a part of the stock market, and the stock market is no longer a reflection of the economy. They are now completely two separate things, so to speak. Now, when I first started trading in 1999, that was a different story. When you had Fed meetings, it was an extremely volatile day. In fact, a lot of traders didn't even bother trading that. When you had employment, GDP numbers that would come out, it was just like a eat popcorn event. I mean, it was completely radical. It had gnarly behavior, and it was just wild whipsaw movement. And over the years, you've seen that kind of disappear. And I think for a big reason, in my opinion, that all started in 2008 after the financial crisis. This was a pivotal period in how the stock market and the economy started to become disconnected from one another. And that is, you really got that theme, the too big to fail. Most of you should already know the story about them, the banks failing, going out of business, government steps in and bails them out. Now, I know that needed to be done at the time, but what I always talk about is every reaction creates an opposite reaction. And what that actually set the tone for was the QE, where the Fed is basically purchasing assets into the stock market. So as they're constantly doing this, they use that tool to support and maintain the health of the markets. In that case, back then, it needed to be done. The banks needed to be saved. But since then, that rule has sort of been abused. You started to see that continually be used throughout the last administration. Even while employment was at record lows, the Fed was still buying, still printing money, and still purchasing these assets and not allowing the market to work or, work its own problems out, sort of like a babysitter, like the Fed is one big mother to the entire market, supporting it through there. Also, larger corporations realized that after the 2008 banking crisis, that you are too big to fail. That little moniker or whatever is true. There are businesses that are too big to fail. And when they need money, for example, Boeing's or other large airlines or travel industries, When they need money, they get it. And I think you saw that over the last couple of years as well. Whenever these companies needed billions or even trillions of dollars, they got it with one phone call. Where people at home that are still waiting on stimulus checks, right? So they realized that you could continue to abuse this system with no consequences. If they went out of, if they got into any trouble or had trouble, that the government would bail them out. And still to this day, that has relatively been true. So when you move to that, it changes the dynamic, because as long as the Fed is buying, and like right now, I think the last statistics were the Fed is buying somewhere around $120 billion of assets every month. So if they're already flooding the market with that kind of money, it makes it, you really basically need 120.1 billion of selling to get something to go red in theory. And it's obviously more complicated than that. But that's one of the reasons why we have this disconnect. Also, you have to look at who owns stocks in the first place. I know you talk to your buddies here and there or other people, and they talk about a couple of positions they own. But for the majority of people, they really don't own that much in stock. In fact, statistics say that the 75% of all the assets that are owned in the stock market belong to the upper 1% of income earners worldwide. So what is that? That's considered 250,000 United States dollars. So that means that, those are the only people, not the only people, those are the majority of people that are invested into the stock market. So 75% of the assets are for the wealthy. They've got most of their money in the market. So when you're talking about all those underneath of that, when you look at their assets, I'm not saying this is for everybody, but typically you'll probably find that most people are this way. The majority of money that they have is wrapped up into their home. It's into their real estate. And they have a couple of bucks floating around in a savings account, or they've got a few bucks invested in the stock market. My point here is they don't make the stock market move. There's not enough of the smaller retail investors still, even with all the new traders coming in with COVID, to really move the needle. Who moves the needle is the elite. Who moves that is the ones who have all the money. Now, if we can kind of rewind 4 years ago when Trump took office, one of the things that he did early on was cut taxes for the wealthy. Remember, these people were paying somewhere, I'm not completely perfect on my numbers, but they were somewhere in the 35% range, moves down to like 25, maybe even the 20s. Now, if you think of somebody that's really rich, let's talk about the elite of the elite, the Elon Musks, the Jeff Bezos, the Mark Zuckerbergs, right? You're talking about them paying 35% tax, now down to 20. How many billions are they saving alone on taxes? Now, I understand at the beginning that was to trickle that down into their businesses, right? That was to trickle down into hiring people. And to some degree it did, but still, out of that tax plan, they were the direct beneficiaries of it. So if you're somebody that has several billions and billions of dollars, and now you have several billions of dollars more for doing absolutely nothing just in the tax code, you can only buy so much artwork and real estate before you run out of places to put this money. And that's really what they have. They don't have no place to put this money. And it goes into stock buybacks where they're actually buying their stock back. So if you're kind of new to trading, you say, what is that? That's when companies buy the stock back and take the supply out of the float of shares, and it increases the value of stock. It makes it rare, more rare. I'm trying to say that the best I can. But anyway, these are the people that are invested in the market. These are the people that are holding the market. So even while the economy itself is disintegrating for the average person, the rich themselves are getting richer. Now, we also know in this time, which is a completely different speech and a different topic, is during this time we know that when you're on lockdown, people spend more money in Amazons because your local retailers have been forced to close. We spend more time on places like Instagram, YouTube, and Facebook. So we spend more social media time. So those elite businesses got even more elite. They made even more money. And they have no place to put that. So when you're looking at it, you say, why can we continue to do this? Well, this is the type of world that you live in. And from the time that I started 2 decades ago till now, this is what we have seen that was different. And when they first came out, like if we go back and we look early on into like the dot-com crisis, and we look back to that and we think, what was the differences then versus now? Well, I can remember when these companies started to go under and they started to have trouble, the government, the Fed was just like, whatever, you guys are on your own. That's what you get for trading stocks. There was no bailouts for them. They even got up to that point in 2008 with Lehman. They decided we're not going to bail out Lehman and they let them go. And then they realized the ramifications would be horrible if they did that with everybody. So from that point on, it changed. These things change. So the lesson here is this, guys. Why does the market go up? Well, the market goes up because the elite continue to become more elite. And they're making record profits. Even in coronavirus lockdowns, they are making record profits, especially these technology companies. And I think we've seen just here recently, which again is another topic, just how much clout and influence that they have and the power that social media has over our entire world. But they become more wealthy and they are the ones that's buying the stock. They are the ones that investing. You take those people plus the Fed, it doesn't matter if every single person is unemployed, these people will still have lots of money and that money will go to the market. And not only that, there's always fresh, new, hungry, young money that's just been made that needs to be put somewhere. There's always money from somebody, somewhere, that needs to be put to work someplace. And the easiest, most liquid, most quickest way to ever gain any return will always be stocks over any other kind of assets, real estate, art, and all that good stuff. So that's why we have this disconnect. So in a recap, first of all, it was created by the Fed in '08. They really set the precedence by continuing to offer QE, and we're doing that now. We're still supporting the market. The Fed is still printing money and buying assets, basically creating money out of thin air and buying assets. So that's why you hear that thing, don't fight the Fed, because us little retail traders, we can't move the needle here. We just have to, and I'm telling you guys this because if you want to be successful, you can't complain about it. It's like they say, what is it? You don't hate the player, hate the game. If you want to be here, you got to play the game, and that's the game. They're going to continue to buy it. And with that, you've seen how much difficult it is to short stocks, something that had an incredible edge years ago, which is almost non-existent. It becomes harder and harder to do that. The second thing is the group of people. The elite of the elite control most of the worldwide wealth now. And they control over 75% of the wealth in the stock market. So as long as they're getting richer and wealthier, they're less likely to pull their money out of the market and use it for something else. They've got to put it somewhere, and this is where they decided to put it. So kind of remember that. I think you see that now, these economic numbers, as long as the Fed is keeping rates at 0 or better, or they're just not going to raise rates, and as long as they're doing QE, it's going to be close to impossible to ever get a crash in the market. You just won't accept, and if you do, it's going to be something that's so fast and so short term. And I would think at this point, it would just literally be engineered. Like they would just purposely do that. So anyway, guys, that would be the answer to that. As always, if you need help, feel free to reach out to me. Also, if you guys got other topics for the next couple of happy hours that I'm doing, anything that you want to talk about, send me emails or just anything that you think the trading community would benefit from, feel free to put that down into the description box or down into the comment sections. I'll be glad to put that on the agenda. Until the next one, trade well, guys. Take care.